Okay, so welcome everybody. So sorry about the delay. So today we had like a small technical problem, but hopefully we are all here today for Yiming's talk about banks' venture investment in fintech. So Yiming, you will have 40 minutes. Paul Beaumont from McGill is
when you say who's going to work for that, right? Is this the issue?
So as usual, so if you can turn on, your video, your camera on, so that makes, the seminar more lively and more interactive for the presenter and for the discussants. So if you have any questions, so please drop them in the chat, or you can raise your hand. We'll pause, every 10 minutes, to take questions. And or Yiming, if your co-authors are here, they can also enter the questions in the chat. And yeah, so I guess we can start. So the floor is yours.
Thank you very much. Very happy to have this opportunity to present this paper from competitors to partners, banks' venture investments in fintech. So this is a joint paper with Manju, Puri, and Xiang, Zheng. So as we know that banks regularly make venture investments in startup companies, but unlike traditional VC funds, banks, when they make these investments, not only they seek financial returns, but they also have important strategic motives. So an earlier paper by Manju, Hellman et al. 2008, they document that banks, when they make a VC investment, a primary strategic motive is to cultivate a relationship for future lending business. So in other words, by making these financial investments, it gives them a competitive edge in their core business, that is the lending business. So fast forward 20 years, the competitive landscape of the banking industry has undergone significant changes, primarily due to the emergence of fintech competition. So every day we hear all these discussion about the disruptive force of fintech to the banking industry. So in this paper, we ask the following question, that is, in light of the change in the competitive landscape, has the strategic focus of banks' venture investment also evolved in the last 20 years? So we hypothesize that in the last 2 decades, banks have used venture investment in fintech startups as a solution to their fintech challenges. Okay. So there are several reasons why such investments might help with their fintech challenges. So first, by investing in a fintech company, they can gain access to the innovative technology of the fintech startup company. So they can learn from the startup company. They can incorporate their technology. They can even encourage the investee to make custom their technology development to cater to the bank's special needs. Okay. Second, rather than engage in head-on competition for customers, they can also, through such investments, they can also foster relationship so they can combine strengths to offer more comprehensive financial services to their customers, both of their customers. So one example of how they can change from competitors to partners, right? So think about Ally and Better.com. So Ally is a traditional bank, and Better.com is a fintech company that specializes in online mortgage lending. Okay? So they do compete with each other, okay, for mortgage lending business. But in February 2019, Ally made a venture investment in Better.com in their Series C round financing. So several months later, they became partners. Okay, so Ally rolled out a new platform employing Better.com's technology and platform to create so-called end-to-end digital mortgage experience. So basically, they just incorporate Better.com's technology and platform for online mortgage lending, so that they don't have to develop such a platform in-house, basically. Okay, so let me give you the main findings of our paper. So first, we document a time trend that in the last 20 years, banks' venture investment have increasingly focused on FinTech startup companies. And second, when are banks more likely to make such investment? So we find that consistent with the hypothesis that they use such investment as a solution to their FinTech challenge, we find that banks are more likely to make such investments when banks face greater FinTech competition. And third, what kind of FinTech startup companies they are more likely to invest in? We find that they're more likely to form an investment relationship when the two companies, the bank and the startup company, when they have higher ex-ante synergies, that is, when they have higher technological or business relatedness. And finally, we're also able to document treatment effects, that is, financial investments by banks in FinTech startups result in a strikingly higher likelihood of business collaborations between the two parties. Okay. So when we say a striking higher probability, that is compared to a pair of bank and a FinTech company that do not have any financial investment relationship. In addition, the two firms, new patents, that is post-investment new patents, tend to have, so they were more likely to cite each other, consistent with knowledge transfer between the two firms. Okay. So, so our paper adds to both the banking and FinTech literatures. So first, it adds to the literature how banks adapt to a changing financial market in face of the disruptive FinTech challenges. So the literature has shown, prior studies have shown that in face of such challenges, banks invest more in information technologies. So there were a couple of papers on that. They also change hiring strategies. They tend to hire more IT talents, and they also provide more digital services. Okay. So our paper shows that in addition to these strategies, they also use venture investment as an important solution to such challenges. Second, there are already several papers studying banks' investment in FinTech firms. However, they have very different focuses. So prior studies show that banks prefer to investing in more mature and later stage, more mature firms and later stage deals. Okay. In fact, such a preference is not just unique to their investment to FinTech firms. It is also true when they invest in non-FinTech companies. And then several papers also document that the post-investment performance tends to be better for banks compared to non-bank VC funds, okay, in terms of IPO exit, in terms of investors' stock returns, etc. Okay. So our paper has a very different focus. We show that in particular, what is the bank's motive, strategic motive when they make such investment. And we also document extensive post-investment strategic collaborations. And also our paper adds to the broader FinTech literature. Okay, data sources. We employ several sources. First, information on FinTech startups and their financing information are from Crunchbase. Our bank sample is from core report. So we fuzzy name match banks to the financial investors in Crunchbase. When we measure FinTech competition, so obviously FinTechs competes with the banks in various areas, but our measure focuses on mortgage lending for two reasons. One, mortgage lending is part of core business of banks. And second, we have comprehensive data for mortgage lending. And finally, we hand collect data on business collaborations between bank and FinTech startup companies. So we do so for about 3,600 pairs, actual bank FinTech investor-investee pairs, as well as pseudo pairs. Okay. Okay. So our sample. So FinTech startups. How do we identify FinTech startups? We identify these FinTech companies based on Crunchbase industry and industry group descriptions. So the detail is in the paper. For the sake of time, I'm not going to the detail of the definition. After we identify the FinTech companies, we then classify them into several different spaces, including payments, bank and lending, wealth management, crypto-related, exchange and trading, AI, cloud and IT, and others. So banks, we focus on public banking holding companies and commercial banks. So the reason we focus on public banks is because we observe that there are very few private banks that make such venture investments. So we have a footnote in the paper that we do document several incidents of private banks making such investments, but overall there are very few. So that's why we focus on public banks. So for both banking holding companies and banks, we basically we refer to them as banks, bank investors in the paper. So
sorry to interrupt. So you have a question in the chat. So do you want me to read it, or do you want to take it now?
I cannot see the chat box.
Okay, I can read the question.
Yes, please.
Okay. Oh, Qian is actually taking care of the question, but so it was about how do you track post-investment collaborative activities?
So how do we identify collaborations? Oh, okay. So short answer is that we basically scout the website of the startup companies and Google search news stories with both the bank and the FinTech companies and names. Okay. So basically a lot of manual searches. And then after we identify collaborations, then we manually read the descriptions and classify them into several different types of collaborations. So we will talk more about how we do that a little bit later.
Okay, thank you.
Okay, so our final sample, sample period is during 2001 and 2022. So out of 75 banks that ever made VC investment during the period, we find that 51 of them participated in 475 financing rounds of 323 unique FinTech companies. So in other words, some FinTech companies have multiple financing rounds, which is not surprising. Okay. And that formed 622 observations, bank FinTech round or deal combinations. So that is our treatment sample. Okay, so recall that we have 4 main findings. So first, we document a time trend of increasing investment in FinTech. So this figure shows the number by year, the number of banks investing in FinTech startups. So the dark blue column shows the number of banks that invests in FinTech deals in that year. So the dark blue column, and the light blue column is the number of banks that makes only non-FinTech investment in that year. Okay. So the yellow curve represents the percentage of banks that make FinTech deals during that year. So as we can see, that percentage increases from less than 10% in 2001 to 70% in 2022. Yeah. And we'd like to point out that this trend is above and beyond the general trend, increasing trend of FinTech. Okay. So this gray curve represents the percentage of all investors that investing in FinTech deals each year. So as we can see that the percentage also increases over the years, but the latest number is only about 35%. And then the second figure shows the number of deals participated by banks each year. Okay. So once again, the dark blue column shows the number of FinTech deals invested by banks, and the light blue shows the number of non-FinTech deals invested by banks each year. And the yellow curve represents the number of FinTech deals made by banks each year. So as we can see that in the recent year, 2022, out of all the deals participated by banks, 35% of them are FinTech deals. And once again, this increasing trend is above and beyond the general increasing trend of FinTech. So the gray curve represents the number of FinTech deals by all investors each year. And in 2022, that is 15%. 15%. Okay. So banks, compared to other investors, do have a particularly strong preference in FinTech. I'll skip the next figure for the sake of time. Okay, so second research question: what drives banks to investing in FinTech? So the empirical design, so basically we're gonna conduct a likelihood test. Okay, so the empirical design is that for each treatment sample observation, we create 10 pseudo deals observations. Okay, and then with the matched treatment and the control samples, we conduct a likelihood test for the actual investment. So our treatment sample includes 511 bank deal actual investment combinations. So this is a little smaller than the 600 also pair I mentioned before. This is because the requirement of certain control variables. Okay, so that reduces the sample a little bit. Okay, so for each observation, we create 10 pseudo deals. How do we do that? for each actual bank investor, we match it with 5 pseudo FinTech investees, and vice versa. For each actual FinTech investee, we match it with 5 pseudo bank investors. So the candidates for pseudo investees are FinTech firms that have had financing rounds in the same year, but have not received bank investment. The candidates for pseudo investors are banks, public banks, that have not made FinTech investments that particular year. Okay, so following Ben and Lee, we construct 2 control samples. So the first control sample is a random control sample. That is, out of the candidate pools, we randomly select 5 pseudo investees and 5 pseudo investors. Okay, and the second, we create a matching control sample, specifically propensity score matching sample. So for the pseudo investees, we match based on firm age and the size of the financing round. For pseudo investors, we match based on bank size and book to market ratio. So for one thing, bank size is an important determinant of such investment, because large banks do tend to make more venture investments. Okay, so our first hypothesis is that banks are more likely to make FinTech investment when they face greater FinTech competition. So how do we measure FinTech competition? Okay. So first, we measure FinTech competition in a certain geographical area. Okay. So more specifically in a county. So we measure the competition level with the growth rate of the market share of FinTech lending. Okay. So the reason we focus on the growth rate is as follows, because the market share itself, the FinTech market share itself, depends on how many traditional banks there are in the locale, right? So for example, in New York County that includes Manhattan, the FinTech market share in 2021 is only 3%. The reason is because there are so many traditional banks in Manhattan. However, the growth rate of the market share, the annual growth rate, is 48%. So as one can imagine, the pressure each bank feels about the up and coming FinTech lenders could be very big for each bank. Yeah. So in contrast, in Sherman County in Kansas, the FinTech market share recently is 48%, but the annual growth rate is 12%. Okay, so not too much. And more so, another county in Montana called Fulton County. Okay. So the market share, FinTech market share, is 48%, but the annual growth rate is only negative 14%. So actually, the competition pressure is actually declining recently. Okay. So for that reason, we focus on the growth rate. Okay. Okay, so we first measure the competition level in each county. Then we say that because of the different location distribution of each bank will face different FinTech competition. So what we do is we for each bank we calculate the competition it faces as the average FinTech competition across each county that the bank has a branch in, weighted by the number of branches it has in each county. Okay, so this summary statistic table presents, among other bank characteristics, the different levels of fintech competition the banks face. So there are 3 columns here. The first column shows the actual bank investor, and the second column presents the number for the random control sample for the pseudo investor, and the last column presents the number for the PSM pseudo bank investor. So as we can see, the actual bank investor faces higher fintech competition. So 35% versus 24% and 25% for the control, for the pseudo bank investors. So that's a quick indicator that the actual bank investors face higher competition. Okay, so here's the regression results. So here we have we combine the actual treatment sample and the pseudo bank investor, the control sample. Okay. In this test, we use the PSM pseudo bank investors, and results are robust if we use the random control sample. Okay. So as we can see that we find a significant and a positive coefficient on the main variable, that is fintech competition, consistent with the hypothesis that the greater the fintech competition they face, the more likely the bank will make venture investment in fintech competition. Okay. In fintech startup. Okay. So in terms of economic significance, a 1 standard deviation increase in fintech competition is associated with a 2 percentage point increase in the likelihood of an actual investment. And this compares with, so here in the sample, we use 1 actual deal plus 5 pseudo deals. The reason we use only 5 pseudo deal rather than 10 pseudo deal is that here we only look at the bank's decision here. So so we only use the actual fintech startup company matching with the 5 pseudo investors. We leave out the actual investor matching with the 5 pseudo startups. Okay, so in this sample, the unconditional probability for actual investment is 1 out of 6, right? So around 16%. 16%. Okay. So the economic significance therefore is quite large, 2 percentage point compared to the unconditional probability, 16%. Okay, let me see. Okay, so second hypothesis is that a investment relationship is more likely to be formed when the 2 parties have ex-ante synergies, that is, when they have higher technological or business relatedness. Okay. So how do we measure technological or business relatedness? So we measure technological relatedness based on the 2 firms' patents data. So first, we measure their technological overlap based on the cosine similarity of the technology classes of the 2 firms' patents. Okay. And then we measure the likelihood that the 2 firms' patents will cite each other. Okay. So first we measure cross citations without directions. Okay, so either way, okay, can be bank cites FinTech or FinTech cites bank. Okay, and then we measure the directional cross citation. Okay, so cross citation by bank of the FinTech or the cross citation by FinTech of the bank's patents. Finally, we measure the two firms' business relatedness based on the description of their industries by Crunchbase. Okay, so we measure the number of keywords that are in both firms' industry descriptions, and or we measure the percentage of overlapped keywords. Okay, so by the way, this measure is because the industry description is a snapshot in the data, so it is a time invariant variable.
So Yiming, just to let you know, so you have 7 minutes left.
Oh, only okay. So I will speed up. Thank you.
Thanks.
Okay, so again, we conduct the likelihood test. This time we use 1 actual deal plus 10 pseudo deals, because now we are looking at measures that are pairwise measures based on both firms' characteristics. Okay. So we find that the likelihood of actual investment is positively related to technological overlap. Okay. And it is also positively correlated with cross citation between the two firms. Okay. And when we divide the cross citation into 2 variables, okay, so the directional cross citation measures, interestingly, we find that what matters is the cross citation by the FinTech firms, okay. And finally, we also find that the investment relationship is positively related to business relatedness as well. Okay. Okay, so the last research question: how do banks benefit from investments in FinTech firms? Okay, so our main hypothesis here is that these financial investments will lead to business collaborations post-investment. So how do we identify their business collaborations? Okay, so as mentioned a little bit before, for each actual and pseudo bank FinTech investment pair, we hand collect information by exploring the FinTech firm's website and Google search news stories. In fact, we first started with the bank's SEC filings and their website, but we do not find much, because to banks, these investments tend to be, small deals. So they hardly mention the FinTech names in their SEC filings. Okay. So after we identify collaborations, we then manually read the description and classify the partnerships into 3 types. So the first type is banks utilize the FinTech technology. Okay. And then second type is FinTech cross-sell to banks' customers. Okay. And then third type is cross-selling in the other direction. That is, banks can cross-sell to FinTech's clienteles. So let me give you one example for each type. Okay. So first, banks utilize FinTech's technology. So in fact, the first example I mentioned at the beginning of this presentation between Ally and Better.com, if you remember, is actually an example of this type of collaboration. Okay. So another example is Live Oak Bank. Okay. Have a partnership with a defense storm. Basically, they use defense storms cyber security technology. Okay, so for the second type, FinTech cross-sell to banks customers. Okay. One example is American Express offered to its credit card members statement credits of either 2,000 or 6,000 if they originate or refinance their mortgage loans through better.com. Okay? So they are helping their FinTech investees to get more business, basically. And then for the last type, okay, banks can sell to FinTech's clientele. Okay, so here the example is between Sterling National Bank and the Coauthors. So Coauthors is a FinTech company, focuses on financial education for young people. Okay, so Sterling basically, join Coauthors in a campaign to bring savings account to 1 million students. So basically, they are selling to Coauthors clientele, that is young students. Okay, so this is summary statistics table.
3 more minutes. So sorry to interrupt.
Okay, thank you. Okay, so let me show you this summary statistics. I think is very interesting. So this summary statistic table shows the frequency of post-investment collaborations between the treatment sample and the control sample. Okay, so as you can see, among the actual investment pair, 31% of them ended up with post-investment collaborations. In contrast, among the control sample, only 2% have ever had collaborations. Okay, so that's what I call a striking difference. And in addition, I'd point out that the vast majority, 95% of the collaborations happens after the financial investment. Only a very tiny percentage, maybe like 1% of collaborations among the treatment sample occur before the financial investment. Okay. So as we acknowledge that there is a selection effect, okay, between the pair. So however, if there's only selection effect, okay, collaborations happen with and without financial investment, then they should happen equally possibly before and after financial investment. The fact that almost always the collaboration occurs after the financial investment is very telling that the financial investment facilitates the collaboration. Okay, so we acknowledge there is a selection effect. In fact, our third hypothesis focuses on selection effect, but we believe there's also some treatment effect. To identify the treatment effect, we use a IV test. So we need an instrument that is positively related to the venture investment, but not directly related to the business collaborations between a bank and a FinTech company. So for that purpose, we use the percentage of VC investment deals made by a bank in the FinTech company's locale as an instrument prior to the actual investment. Okay, so the idea is that the bank's VC market share in the locale represents the general funding availability of the bank in that location. So that should be positively correlated with the likelihood of investment, but it's not directly related to business collaboration between the bank and a specific fintech company. Okay, so the first stage regression, we find positive correlation between the instrument variable and the likelihood of actual investment, highly significant coefficient. The F test is around 20. And then second stage also shows that the instrument is significantly and positively correlated with post-investment collaborations. So that is consistent with causal effect that the actual investment facilitates post-investment collaborations.
Yiming, in the interest of time, so can you conclude?
Okay, so let me also just say one more result, that is the instrument test also shows that it leads to more post-investment cross citation. Okay, now let me, I'm sorry. Okay, somehow I hide the conclusion slides, but let me just conclude without the slide. So basically, our paper documents a increasing trend for banks to invest in fintech startups. Okay, and we find that they do so as a response to fintech challenges. Okay. So we find the two evidence for that. One is that they're more likely to do so when they face greater fintech competition. And two, they're more likely to invest in companies that have higher ex-ante synergies with them. And finally, we document treatment effect, that is such venture investment facilitates post-investment collaborations. Okay. So we believe that our findings have policy implications, and our findings provide basis for cautious optimism, that is without much regulatory intervention, the new and old players in the banking industry, they can coexist and grow together. Okay, with that, that's how much I want to say.
Thank you very much for this very interesting presentation. So Paul Beaumont from McGill University is the discussant. So Paul, you have 15 minutes.
Can you hear me? Can you see my screen? Yes?
Yes.
Okay,
but
perfect.
Your screen is not like a full screen.
Yeah, give me one sec. Now it works, no? Okay. So thanks a lot for giving me the opportunity to discuss this very interesting paper. So as you know, the topic of the paper is banks investment in fintech. So before going into the details, I think it's worth like kind of going back to the big picture and try to understand why firms like invest in VC deals, why some firms actually like acquire minority stakes in startups. Okay. So the first thing to know, and this is a graph that I borrowed from the paper of Zheng at the in the RFS in 2019. The first thing to know is that like corporate venture capital, it's not a sideshow. It's actually quite important. Like about 10% of VC deals actually are backed by private firms or corporate venture capital deals. Okay, and on top of that, you can see that this phenomenon is rising. It's like we have more and more deals like this over time. Okay, so why does this exist? Why do firms invest in VC deals? Well, the theoretical literature suggests that this is because strategic interactions between firms, between an incumbent and a startup, are difficult to realize with contracts. Okay, so the idea is that imagine that you are an incumbent firm, you have developed a technology, and suddenly there is a new startup that has developed a new technology that is complementary to yours. Okay, so you, as an incumbent company, you would like to form an alliance to partner with that startup. But from the point of view of the startup, it's very difficult. It's very dangerous to do that. Okay, why is that? Because So this is a quote from that is extracted from the paper of Matthews 2006, and this is a quote by a software company executive. As a company, if you make your technology available to an alliance partner in anticipation of getting something in the future from the incumbent company, what you've really done actually is to enable a competitor who can outmarket you anytime it wants. Okay, so like as a small company, it's very dangerous to partner with an incumbent because there is the risk that the incumbent will just like copy your company, imitate your business model, and outcompete you. Okay, so what the literature suggests is that actually like having the incumbent invest in the startup is a way to solve this problem, because on the one hand, allowing having the incumbent invest in the startup like allows the incumbent to kind of influence the decision of the startup. Like the incumbent can get a seat at the board, for instance, in order to like influence the decision of the startup and to make this alliance happen between the incumbent and the new firm. But on the other hand, by having the incumbent buying a stake in the startup, you dampen the incentive on the incumbent to destroy the startup, to just imitate and copy and outcompete the startup. So this is, in some sense, this is the best of both worlds, because we get those strategic interaction, and on the other hand, we manage to avoid to prevent the incumbent firm from just like imitating the startup. And what I like with the paper we are discussing today is that this is very much in line with this line of theory. Okay, so here we have on the upper panel the probability of observing an alliance, a partnership between a fintech and a bank. And in the upper panel, this is only fintech bank pairs in which we observe a VC deal. In the lower panel, we have like fintech VC, fintech bank pairs in which there is no VC deal. And what you can see, and this is very striking, is that you only observe an alliance when there is a VC deal. So it's very much in line with the predictions of the literature, and I find it personally fascinating. Okay, and on top of that, what the paper does, and I think this is also like to the credit of the authors, is that they manage to kind of document the type of alliances fintech and banks form after the VC deal. So it's either like knowledge transfer, so like a kind of like banks learning from fintechs and vice versa, and also like cross-selling. So by cross-selling, it's like a bank referring its customers to the fintechs and vice versa as well. Okay, and these strategic interactions are made possible by VC investment. Very briefly, if you want to place this paper in the literature, you can take this graph. I will be brief because like Xiang already Yiming already touched upon this. So here you have the bank's investment in VC deals. If you focus on the early period, so like before 2008, you can see that banks were investing mostly in non-fintech startups. So there is a paper, Puri and Lindsay, that explains why. The point of this paper is like banks use venture capital investment to kind of build a lending relationship with startups to make sure that they would be the lender of those startups in the future. If you take the end of the period, you can see that banks mostly invest in VC deals in fintech startups. I mean, the nature of the investment has changed, so it must be that the nature of the strategic interaction has changed as well. So the point of this paper is that banks now use venture capital investment as a way to react to competition with fintechs, to navigate fintech competition. Okay, so my opinion, I find the paper super exciting. I'm a bit biased because I also have a paper on fintechs, but I think the paper makes a very nice contribution to the literature. And I will have 3 sets of comments. Okay, so I will kind of come back to the questions of why banks partner with fintechs. Then I will talk about like post-deal strategic interaction, and if I have time, but I doubt I will talk about like the identification. Okay, so why do banks partner with fintech? So here I will borrow a dichotomy from Mar 2019. There are essentially 2 ways to understand why banks may want to partner with fintechs. So it's either to fix their weaknesses or to build on their strengths. Okay. So what is the story? So like if it's about like fixing their weaknesses, then the story is like banks actually like some banks are not very innovative. They do not manage to keep up when it comes to technology. So what they do is that they acquire or invest in innovative fintech to kind of like absorb their innovation. Okay. The second story is actually like as a bank, you will only be able to benefit from the alliance with the fintech if you're already innovative. Okay, you have to have complementarities for the alliance to be profitable. So only innovative banks will invest. So, and I think this is actually quite important to disentangle between the two hypotheses to know which version prevails in the data, because it will shed light on whether it's non-innovative banks or innovative banks that benefit from the alliances with fintechs. And I think it's actually important, either for policymakers and for economists as well. So, let's try to consider the first hypothesis, the fixing their weaknesses hypothesis. Currently, perhaps it's my reading, perhaps I'm not being objective, I don't know, but I think currently the paper has a bit of that flavor. For instance, like in the descriptive statistic section, the paper says banks make fintech investment when they can and when they need to. So like lower growth rates incentivizes pursuing new growth opportunities. So the paper has a bit of that flavor, I would say. But I don't think it completely fits the data. So, for instance, the fix their weakness history, like kind of predicts that less innovative, less performing banks should invest more in order to fix their weaknesses. And this is not what we observe. Like banks' number of new patents does not predict investment in fintech. And actually, like if anything, growing banks seem to invest more. The second thing is that one strong predictor of the fintech, of a bank investing in a fintech is that the fintech quotes the bank's patents. If a fintech quotes the bank's patents, the bank will be much more likely to invest in that fintech. But if a fintech quotes the bank's patents, it must be that the bank has patent and hence is somehow innovative. Okay, so it seems that investing banks are innovative. Okay. Another thing is that this fix their weakness history. In this view of the world, the bank does not care so much about the startup itself. The startup is purely a vessel. It's a mean for the bank to acquire innovation. Okay, so in this view of the world, the bank will like absorb the productive resources of the fintech, and it won't take any action to make the startup grow. Okay. And this is not the case here. We see that like banks refer their customers to the fintech. So it's again, this is, in my opinion, not consistent with that. One thing that could be cool and useful, I think, would be like to document a bit what happens to fintechs after the VC deals in terms of survival, for instance. Like Ma, 2019, he finds higher termination rates for startups after a VC deal, after a corporate VC deal, more precisely. It may be useful to kind of try to document that as well, to shed light on this dichotomy I'm currently like discussing. Okay, so let's consider the other story, so the build on their strength story. So here, this kind of theory, so this idea, this view of the world is really like related to theories of investment or M&As that are based on complementarities. The reason why M&A exists is because there are complementarities between the acquired and the acquiring firm, and by making those two firms work together, by merging those two firms, it's the only way to make those complementarities actually happen. Okay, and these theories typically predict associative matching. So like technological. Innovative will buy innovative, large will buy large, and so on and so on. This is exactly the type of pattern that we have here. Like there is more investment when there is technological overlap, business overlap, or cross-citation. Okay. Another thing, and I think it should be stressed more in the paper because I find it also super interesting, in terms of timeline. So it seems that so as I said already, when a fintech quote the bank's patents, it's a strong predictor of the bank investing in that fintech. But what we see in the author's findings is that after the deal, the number of citations between the two firms seem to increase, and this increase seems to be driven by banks' citation from fintech's patents. So in terms of timeline, it seems to be that fintechs quote banks, and then banks quote fintechs. But this is really it's very much consistent with the existence of complementarities between technology, which again is consistent with the build on their strength story.
So
I think
you have 3 minutes left, but before you continue your discussion, I'd like to thank all the participants to this talk. So thank you for coming. So sorry about the delay in the beginning, and stay tuned for the next WEFI announcements on our website. So Paul, you have 3 minutes left, and then we'll give the authors the opportunity to respond to your comments, or we'll take some questions from the audience. So sorry for the interruption.
No, that's perfect. I think I should be able to finish. I think one thing that the paper could try to do, I know it's probably a long shot, and this I know, is to try to say a bit more on the nature of the complementarities between the activities of banks and fintech. So the offer, uncollected data from the fintech and the bank websites to document the presence of alliances between banks and fintechs. Any form of analysis on the nature of the complementarities that is allowed by these alliances would be fantastic, would be a super nice contribution to the literature. Very briefly, my second comment. So one important finding of the paper is that banks and fintech, they form strategic interactions after the VC deal. And one question that the authors want to address is is it about selection or is it treatment? And they propose an IV to kind of separate the two alternatives. And the idea of the IV is that if the bank has already invested a lot in VC deals in the area of the fintech will likely continue investing in VC deals in that area in the future. So they use the percentage of VC deals in which the bank has invested in the fintech's area as an IV to kind of rule out selection effects. The idea being that this IV will predict the probability to invest in the area, but not to invest in a specific firm, which is fine, and it has been used in a previous paper as well. I just want to say that I think more could be done to convince the reader that this approach is valid, because imagine if all fintech VC deals occur in one single location. If that is the case, then the IV approach is actually ineffective at ruling out selection, because it will basically the IV will positively predict the probability of investing in a VC deals in the Silicon Valley. But in the Silicon Valley, there are actually tons and tons of fintech VC deals, so there will still be a selection at play. Okay. One last thing, and then I will be done. It's not completely clear to me why we want to rule out selection. I think I'm completely fine if the paper says banks invest in VC deals in order to form strategic interactions. I think more emphasis could be, the paper should try to emphasize more the timeline. Theory predicts that strategic interactions should only be formed after the VC deal. And I think this is what you observe in the data. In my opinion, this is enough, but it should be put forward more in the paper, because it's all that we need to reconcile data and theory. And I will skip my third comment. I really like the paper. I highly recommend you read it, and I wish the authors good luck with the paper.